As the stock market is crashing lower, is now the time to be buying aggressively? Well, Michael Burry, one of the greatest investors around, admits to feeling greedy. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. I've been talking about for some time that I expected the stock market to head lower. I've even called out that it wouldn't surprise me to see the S&P 500 breach 3,000 over time. You certainly have tough monetary conditions, and you're starting with lofty valuations and still high inflation. So we'll see how that plays out over time. But what else is Michael Burry, arguably one of the greatest investors, thinking? Well, he's saying the current environment reminds him of 2000, mid to late 2000, where you're looking at different sectors of the market where free cash flow is totally on sale and ignored, while formal momentum stocks are coming down, but not far enough. And darling better businesses still had a ways to fall. Value was about to take off for years despite more crash on the way. Really interesting point. Let me sort of break that down and say, why is that interesting as it compared to today? Because he's saying that period in 2000, and arguably it's important to understand this about Michael Burry and his track record. He didn't just get the great financial crisis right. He also nailed the dot-com bubble, where he outperformed during that period by focusing on free cash flow cows, companies that generate a lot of cash flow, and he was able to buy at a reasonable valuation. And he's saying, hey, those businesses, some of them are on sale, so you have to look for them, and that's tough. And I'm going to call out one of those free cash flow cows in just a second. But arguably, a lot of these momentum stocks, that were previously Wall Street favorites, they're down 70, 80%, but they still haven't proven their business model. They still haven't proven, let's say, their free cash flows. They haven't gone to scale yet. And as they've come down, arguably in a tougher investment environment, which includes having higher interest rates, that is going to put the squeeze to them where you might see even lower valuations. And that's why I repeatedly say, if you're going to get greedy, if you're going to aggressively buy, you should be penciling out opportunities where you can say 300, 400, 500% upside, and talk about why you can easily get there, and not just, oh, well, the stock price previously was there. You need to say, hey, does the fundamental support it? Does the valuation support it, and get you there? And he's also talking about how these better businesses, these premium businesses, and I've talked about this before once again, these better businesses still trade at lofty multiples, still have a ways to go, especially if you have a weaker economy in 2023. And so it's interesting for him to talk about this, sort of saying, hey, this market reminds him of 2000 when he outperformed. And he also talks about how low price to cash flow businesses are different today versus 2000 because effectively they're much more shareholder friendly, more willing to buy back stock, pay down debt at a discount, and manage their debt better, making them statistical values. This is a really interesting point. Math problems that more or less must work out. And what he's talking about is, there are three ways that you can make money with stocks. You should always know these three different ways. Like if you're buying or selling stock, you need to know this. So write this down if you don't know this. There are three ways. The first way is, what's the cash that's getting returned to you as a shareholder? That's number one. Number two, what are the underlying fundamentals of the business? Are they growing or are they contracting? Those are the first two ways that you make money. The third way is valuation. Valuation is what confuses most people because that is the daily movement in the stock price, and that's what causes people to think they're geniuses one day and losers the next, zero to hero and back. And what you're seeing is valuation, dramatic valuation fluctuations, partly because of monetary policy, partly because one year you have 1 month, you have massive quantitative easing, and then the next month you have massive quantitative tightening, and that drives dramatic changes in valuation like you've seen. A lot of these businesses, they actually haven't changed that much. It's just the underlying sentiment and the cash flows that comes from, effectively the central bank making some tweaks on the margin, the quantitative easing, quantitative tightening, has just dramatic impacts on valuation and how things are valued. And so what he's saying is, you have these statistical values. If you're able to, let's say, buy a company at 10 times free cash flow or less, if the company can indeed return that free cash flow to you as a shareholder, that's the equivalent of getting 10% per year. If you're able to buy something at 10 times earnings or 10 times free cash flow. So even if you don't get valuation expansion, even if you don't get growth, you're still getting that 10% a year. So the trick is finding those companies that, let's say, trade under 10 times free cash flow. And so where could we find examples like that? So let's actually look at the king of cash flow himself, Warren Buffett. Well, what's he been buying for his portfolio? Well, one of the top positions he's been buying is Chevron recently. Now, admittedly, this is going to be tied to oil prices, but look, They are still one of the top 10 oil producers in the world with global operations. And you look at their free cash flow, they're trading at under 8 times free cash flow. And they're increasingly returning that cash flow to shareholders, talking about $5 billion getting returned to shareholders in the most recent period. And so that might be through dividends, that might be through buybacks, but over time, if the cash flow gets returned to shareholders and it trades at under, let's say 10 times, that's going to be a 10% return potentially for shareholders. Now, the challenge is what happens to that cash flow over time. Is it stable? Is it increasing? Is it decreasing? In this environment where you have a tighter oil supply, then that's, I'd argue, why Warren Buffett is buying. He's saying, hey, a lot of oil producers aren't necessarily friends of Western governments. You've seen this past week, them saying, hey, we're going to effectively stick it to you and cut oil production. Well, in that case, you probably want to own friendly oil producers like Chevron that still, by the way, trade at under 10 times free cash flow, which Warren Buffett's looking for at least a 10% return over time. So he's saying, hey, this checks out. He's paying it, under 8 times. So it's an even greater return. So that's what he's looking at. Now, what do I personally think about the current environment? What am I seeing? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. In full disclosure, this is not financial advice. I think it's really important to take this in context that Michael Burry says, hey, I am feeling greedy, but just remember, I was feeling greedy on the long side in 2000, and the bottom happened in October 2002. So as you see the carnage happen, it's natural to say, hey, let's look for these bargains. But wait, sometimes the pain will take a lot longer than you expect. And these bear market cycles can last longer than you expect, especially as the Federal Reserve is currently showing no signs of stopping, especially when you have an environment like today where just earlier today, they announced that unemployment actually went lower. And so that gives the Federal Reserve mandate to continue putting the screws to the economy to beat inflation. So when you see something like Michael Burry saying, hey, I'm feeling greedy, but I was also feeling greedy in 2000. Now, he performed well because he was buying these really cheap free cash flow companies. So that's something, for all of us to look out for. And if you think you have a very stable free cash flow company that's under, let's say, 10 times or under even 15 times, feel free to call it out. I think the key takeaway is that if the greedy takeaway, I personally don't like saying greedy. I sort of like, hey, let's get compensated if you're taking risk in this environment. That's personally how I feel about it, which is that you have a weaker environment, you have a tougher environment with, effectively interest rates moving up and the Federal Reserve potentially really hurting the economy in the next year. And so if you have these risks, I want to be paid. I want to get compensated. And so I want to be able to pencil out something where I can say, hey, this has hundreds of percent upside, not 100% upside, not 50% upside, hundreds of percent upside. And I called it out to my Unrivaled Investing subscribers. Usually I don't do this, but this past week, for example, I did a letter calling out Brookfield Asset Management. And this is an example, and in full disclosure, I own a little bit of Brookfield. If you want the full detail on Brookfield, though, I do save the exclusive video for my Unrivaled Investing subscribers, but you can check out management's presentation as you see fit. And here it is. This is the example that I want you to take away from this, is that management is sort of saying, yeah, we are penciling out 4 to 5x higher stock price over the next 5 years. That is the type of thing that I'm looking for. If you're not talking about 3, 4, 5x upside from here, in this environment, I'm not interested. And I think that's the real takeaway that every investor should be thinking about right now is really, what are you playing for? Because if you are facing the depths of a potentially scary recession, potentially scary bear market, will you get paid for the actions you're taking today? Will you get paid for the purchase that you're making today? So me personally, every purchase I make, I'm raising that hurdle. I'm saying, hey, I want to make sure you're looking at dramatic upside from here. So if this video has been helpful for you, talking about Michael Burry saying what he's looking for, personally, I'm not looking for I see those momentum stocks. I own a few of them, those former favorable momentum stocks. Really, they're ideally hyper growth businesses over time, but they need to prove their business models. I'm looking at them and I'm saying, if you haven't proven your business model, then there's going to be an extra discount. because I want to get paid once again. So I'm gonna pencil out what your growth rate could be, pencil out a range, and I'm gonna pencil out what your margins can be, but I want to get paid for it. I'm gonna say, hey, 200, 300, 500% upside. That's what I want to easily pencil out in my framework when I'm looking at it. Not just hey, 100% upside over the next 5 years. That is for when it's an easy monetary environment. Everyone, funny money's flowing around, things are bubblicious. In a tougher environment like this, you need to fall back on reality. And that's what he's saying. You need to fall back to actual free cash flow and look for those free cash flow bargains. And that's arguably the game Warren Buffett's always playing. He's always just looking for that free cash flow bargain. So once again, if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, and thank you for watching Unrivaled Investing.